All right, let's dive into the second quarter earnings for LGI Homes. In what has been a really brutal market for home builders, LGIH managed to post some results that really got the market's attention. So the big question is, what did investors see that maybe the rest of us were missing?
And boy, was it a positive reaction. On the day they reported, the stock shot up over 8.5% on some pretty heavy volume. Now, for a company in a sector that's staring down some serious affordability problems, that's a huge move. So, what exactly was in this report that got everyone so excited? Let's dig in.
So what's the big picture here? Well, the headline story for the second quarter was a solid beat against what the analysts were expecting. LGI Homes really managed to navigate a super choppy market and deliver results that, at least on the surface, looked pretty darn strong. Okay, let's look at the actual numbers. Earnings per share came in at $1.36, which was a nice beat over the FactSet consensus. Revenue also came in a little bit ahead of expectations. Now, full disclosure, we should point out that some other data sources had slightly higher estimates, which would technically make this a small miss. But, based on the numbers most of Wall Street follows, this was a clear win.
Now, this is one of the key reasons for that pop in the stock. Margins. Their adjusted gross margin hit 25.5%. That's at the high end of their own guidance, and more importantly, it's a powerful 190 basis point jump from just last quarter. In an environment like this, protecting your profitability is absolutely everything, and LGI clearly knocked it out of the park here. Okay, but it wasn't all good news. Here's the catch. That impressive profitability, it came at a cost, and that cost was sales volume. Revenue was actually down almost 20% compared to last year, and that was driven almost completely by a 20% drop in the number of homes they closed, which really just highlights how soft the demand out there has become. But even with those tough sales numbers, management was sending a pretty strong signal of confidence. The company went out and bought back over 367,000 of its own shares for about $20.6 million. When a company does this, they're basically sending a smoke signal to the market saying, hey, we think our own stock is a bargain right now. That's a powerful message when sales are slowing down.
So, when you put all of this together, what do you get? You get a very clear strategic pivot. It seems like management made a conscious choice to say, you know what, we're going to protect our margins and our balance sheet, even if it means we sell fewer homes for a little while. Let's break down what that trade-off looked like. And you can see that trade-off laid out right here. On one side, you have the focus on margins. That got them that big gain we talked about. It came from tight cost controls, and they were even able to raise prices in some of their stronger markets. But the flip side was, well, the volume flexed downwards. Home closings fell, their absorption pace slowed way down, and the cancellation rate ticked up to almost 33%. And just so we're all on the same page, that term absorption pace is a really big deal for home builders. It's basically the speed at which homes are getting sold in each community every single month. For LGI, seeing this number drop from 4.3 to 3.0 year over year, well, that's the proof in the pudding of that slowing demand we've been talking about. Okay, so Q2 was solid execution, no doubt. But what about the future? Well, this is where management got decidedly more cautious. They are very, very aware of the storm clouds gathering over the second half of the year. This quote from the CEO, Eric Leeper, really hits the nail on the head. LGI's whole business model is based on building homes on spec, which means they build them before they have a buyer lined up. In a volatile market, that makes it incredibly hard to see what's coming. And this uncertainty led them to make a really big move. They completely withdrew their guidance for the full year. And these are the culprits right here. Management was crystal clear about what's hammering their entry-level buyers. It's the usual suspects, right? Mortgage rates are still way up there, crushing affordability. People are nervous about the economy in general, and the result is that potential buyers are just taking a lot longer to make a decision. So, instead of a full-year forecast, they gave us this more limited outlook just for the third quarter. They're expecting between 1,100 and 1,300 closings. But the thing to really watch here is the adjusted gross margin. They're guiding it down a little bit to between 24 and 25%. Why? Because they're planning to use more incentives to help move some of their older, already finished inventory off the books. So how did the market react to all this? Well, it's kind of like a tale of two different timelines. You have the immediate, really positive pop on earnings day versus a much more cautious view when you look at the longer term. Yeah, LGIH got that nice one-day pop, but you got to zoom out. Over the past year, the stock has gotten absolutely hammered compared to its peers. It's down a whopping 43%, while the big homebuilder ETFs are only down about 10% and 3%. The market has been worried about the risks to LGI's entry-level focus for a while now.
So the feeling out there is what I'd call cautious constructive. It's like the market is saying, hey, great job on Q2. We love that margin control, but we're still really nervous about what's coming next, especially since you pulled your guidance. The stock's been pretty choppy since the report as investors try to figure this all out.
All right, so that's the whole story. Where does that leave us here at Talk Tickers? Let's get to our outlook and our official rating on the stock. Okay, our official rating on LGI Homes is market perform. Look, the company's execution in Q2 was truly impressive. You can't take that away from them. But the combination of these stubborn macro risks, the lack of visibility for the full year, and the fact that the stock is just so sensitive to interest rates, it all justifies a neutral stance for now. Basically, their strong execution is being canceled out by a really tough setup. But just because we're neutral doesn't mean there isn't an interesting, maybe even a little wild trade idea to think about. The thesis here is that LGIH is basically a coiled spring. It's underperformed so much because its business gets hit hard by interest rates. But that cuts both ways. So the catalyst would be any real lasting relief on the rate front. The trade would be to maybe pair a long position in the stock with some options to juice the upside. It's a high beta bet that demand for entry-level homes will just snap back like a rubber band at the first sign of good news.
And of course, we have to say it. None of this is financial advice. You should always consult with a qualified professional before making any investment decisions. Thanks for tuning in.